Hello, and welcome to this month's Agfarm Market Update. My name is Chris Nikolaou, and I'm the General Manager of Operations here at Agfarm. Global grain markets have seen a very strong rally this month, primarily in the United States and Australia, and to a lesser extent in Europe and the Black Sea. Through the month of May, we saw fairly benign growing conditions in Europe, the Black Sea, and the US, excluding a late snow event in Kansas. Market participants became overly complacent as short speculative positions increased in the light of a very large 2016-17 season global wheat carryout. I think for this update, we'll start our commentary offshore and work our way back to Australia. The benchmark Minneapolis spring wheat contract has rallied by 20% since the middle of May as an abnormally hot and dry weather pattern has been in effect. In fact, the U.S. Drought Monitor now has much of Montana, North and South Dakota, and northern Minnesota in moderate to severe drought. These are high-protein wheat areas that usually account for 15% of total U.S. production. Earlier in the month of June, there was concern this weather pattern could spread south into summer corn cropping areas, and futures reacted accordingly, with a rally of approximately 8%, which eventually gave way as a rain eventuated. The present outlook is for cooler weather, which should prevent development damage. However, if a return to hot and dry corn areas in the key pollinating period of July did eventuate, I believe that would lead to an increase in the pricing of Chicago corn futures. Presently, harvest of hard red winter wheat is in full swing, and soft red winter wheat is beginning to get the cut. Reports are that yield is good in both qualities, but protein levels could be better in the hard wheats. As harvest progresses, I also anticipate this will have a selling impact on US-based futures. Across the Atlantic, European wheat harvest slowly begins, and Black Sea supplies are anticipated to finish in the second half of July. We have seen a harsh season in Spain, with wheat and barley production expected to be severely impacted. France has also struggled with a very erratic season, exhibited excessive rainfall initially, and then a very hot and dry last couple of months. Overall, observers predict a European wheat harvest that will still be 5 million metric tons larger than last season's, providing the finishing weather isn't too bad. In the Black Sea, Russia has enjoyed cool and wet weather for the majority of the season. All accounts are that we will see another bumper crop there, with 70 million metric tons plus of production, providing July isn't overly hot. Similar positive conditions abound in Ukraine, apart from the central regions. Expectations are that production should perform near last season's yield. Again, providing finishing weather isn't too hot, the market anticipates production in Russia and Ukraine to total nearly 100 million metric tons. We expect this additional supply will have a strong impact on global markets from the month of August going forward. Closer to home, Australia has seen strong exports of wheat this season. Government statistics have 13 million metric tons of wheat exports between October and April of this marketing year, which is a new record. At the current pace, Australia is expected to export 22 to 24 million metric tons of wheat, leaving a domestic carryout of 8 to 10 million tons, and a stocks-to-usage ratio of approximately 20%. The function of the marketplace this season, or at least to date, has been to increase the disappearance of grain and achieve market equilibrium by way of lower pricing for export. However, in the month of June, we saw this change. Markets reacted to a hot and dry autumn with an aggressive rally in both new and old crop wheat. National markets have rallied in the last 3 weeks by $30, up to $45 in some instances, as the marketplace enters grain rationing mode. Old crop grain is getting priced at full carry so that buyers can carry through to the new season and meet their requirements at that point in time. The Bureau of Meteorology chart shows rainfall deficits for the period of March 1st through to June 20th of this year. We can see serious deficits in Western Australia, Western South Australia, and parts of New South Wales and Queensland. Current pricing levels will be effective in rationing back Australian grain from the export marketplace, particularly as new crop EU and Black Sea supplies come online in the coming months and priced more affordably into competing South Asian markets. It's worth noting that the Bureau of Meteorology updated their El Niño outlook from watch to the more benign inactive earlier this week. They state that all international models surveyed now show ENSO neutral for the balance of the year, and little likelihood of an El Niño event. Let's hope that this has the expected impact and producing regions receive more supportive weather. Agfarm has a suite of commodity management and cropping finance products available to suit your needs. For more information on these, please call 1-300-243-276 to speak with a professional who can assist you and your business in navigating the production cycle. The next Agfarm Market update will be at the end of July with Chris Nikolaou, so tune in then.